One. Hey, good afternoon, everybody. Dennis Mattern with CreativeOne. I am so happy that you are here joining us today. We are going to dive into the world of the vol control. We're going to look at indexed annuity performance. This is where we review our monthly newsletter, our monthly report that goes out. A couple things before I introduce my partner in crime here, my compadre, and that is this presentation is being recorded. So you have the opportunity, the ability to fact check us, to go back. You've got the tape. It's there for you. And then also, so it is being recorded, and then I'll push that out to you. But also, this is meant to be interactive. So if you look to the bottom right corner of your screen, especially if you're on a laptop, by the way, you look down there, there's a robin's egg blue little box, and it says chat. Now, if you do happen to be colorblind, it's going to be a light gray. But click on that. It'll open up the chat. Now, here's something I need to tell you about the chat, though. Chat, everybody sees that. There's another box right there. It says Q&A. I am the only person that sees that Q&A. I will be your proxy. I will ask that question. And what'll end up happening, if your question fits the moment, we'll ask it right there. If not, we'll save it to the end. We do a little Q&A and have a lot of fun. Now, I've said we a couple times. And at this opportunity, I would like to introduce you to my colleague, my friend, my partner in crime, Kevin Cloud, Chief Actuary here at CreativeOne. Kevin, welcome, sir.
Dennis, happy to be here. We've got a great show today, although I feel like we spent the last few minutes doing nothing but setting the bar a little too high for ourselves. So we need to pull it back a little bit. But we've got a lot of really great, interesting information, I think. So number one, I'm glad you're here. Number two, please ask some questions as we go, because I think this is good stuff.
I like it. I was just glancing at the attendee list, and I can't help but notice, Eric, I see you. This is the second time we did a thing this morning. And I see that there is someone who is fact-checking me all day long. So, Eric, it is good to see you here. But as we get started, we do this on a monthly basis, second Tuesday of every month, 3 p.m. Central Time. And the reason we do this is there are so doggone many vol control indices that are out there, the designer indices, however you refer to them. And they're important. And Kevin and I have been having this conversation now. We've actually been doing this for years.
Do we have 5 years under our belts? We did this pre-COVID.
This has been a long time. And, you hear different things about vol control indices. And I think that their day is coming, even though there's just some misunderstanding. But let's dive in. Let's talk about what we're going to talk about. And to do that, let me hit my slide button here. And again, reminder, we are going live. You have the ability to contribute to this conversation. And you're probably wondering, hey, Dennis, what does that report look like? Well, this is a snapshot. She is beautiful. And I will tell you, so we put the benchmark indices out there. We put the past performance so that you can look back at the different indices. But here's a couple things that are different. One, we recently added the link, so you can hit the link to the landing page of each one of these indices. I know that sounds like no small thing, but it took us a long time because it was a lot. There's more to that little cat than you think, right?
There is. We've effectively created a mini portable web page that gets delivered to you every month. That's what it is, with some really concise but highly useful information.
Now, the other thing, there is one difference, and this is why I'm so glad you're here. But one thing that we're going to do today that you don't see on the report is we actually dive in, and we are going to not so much name names, but we're going to name performance. And we're going to apply actual caps that would have been in place 365 days ago, the returns that your clients would have seen. So here's what we're going to do. First, we're going to talk about overall index performance, indice performance. We're going to look then at the strategies, and then we're going to talk some analysis. So let's dive in.
Perfect. Let's roll.
Okay, so Kevin, I'm going to set the table. You bat cleanup as always.
I think that's a mixed metaphor, but we'll roll with it.
Is it? I didn't play.
Wasn't something about bases and setting the table at the same time, baseball and dinner? I don't know.
I'm going to be honest. Once they took the ball off the tee, I was done with baseball. They started throwing it at me, for God's sakes. Okay, all right. So what we're looking at here, what you're looking at on the screen, you're looking at the index and strategy returns for the last 365 days ending the last day of April 2024. Now, here's why this is important. We look at these base indices because these are the building blocks, in essence, of all designer indices. All vol control indices are made up of these parts for the most part. They just put a different spin on it. So it's important to look at the building blocks. So when we look at this, performance that ended 365 days, ending April 30th.
April
30
30th.
days in,
Yes. Yeah,
okay, 30 days. So we see the S&P, we see the NASDAQ. We work our way down the big boys and girls that we all know those names. You get down to the bottom, you see the commodities, the real estate, bonds, and of course our friend gold and U.S. Real estate. So Kevin, walk us through what we're looking at.
I think the story continues to be that U.S. equities, specifically, U.S. growth type equities, driving the returns on 1-year index strategies. When there's exposure to those kind of high fly-in tech type of companies in your index, you probably did pretty well. But really, all equities did pretty well. We go down to the U.S. Ag bond. Not quite as good. And some interest rate movement has probably worked against that in the last few months. So we see a negative there. Gold, I believe gold continues to set all-time highs. I haven't looked recently, but crazy. I think it's been going pretty strong. Which there's all sorts of implications to that usually that's a harbinger of things to come. Commodities, we're still dealing with some inflation that refuses to go away. Oil up and down, and then finally U.S. real estate, which just can't seem to catch a break, Dennis.
Yeah, it's always interesting. Every time I see real estate, I think about it incorrectly, because I think about my neighbor's home prices instead of all that commercial space that's out there. And then gold is just fascinating, because as I see the people that are on the line with us today, as advisors, you always get those clients that come in and ask about buying gold, and you're like, good gracious, do you buy physical gold, or do you don't do that, go out and buy it on the market on an index? But it's fascinating, because you think no one wants gold, because our wives and girlfriends and jewelry and everything like that is silver, and that's not the lay of the land. But then you think about it as the conductor that it is, and other applications for gold. I digress.
I will tell you, just as a side note, since we're on this subject, one of the more frequent questions I get from our wholesalers when they come to me with the question is, what indices have gold exposure? That question comes up quite a bit. Of course, there's a handful of products that have exposure to that pure gold index. At the same time, there's a few other indices that have gold kind of baked in as a component to the overall index movement. So it is out there, but I echo your sentiment. What's the reason you want gold exposure? Do you just want the movement, or do you want the security of having gold and want that physical gold? So different reasons, different strokes, different folks.
Absolutely. All right, we digress. So let's take a look now. We're going to dive into actual returns. So here's what you're looking at. You're looking at a whole mess of vol control indices. And what we're going to do first is you're going to see the actual gross change of that indice for the last 365 days ending April 30th, 2024. And I'm going to probably say that a couple times, but what we're looking at, the gross returns. Now, when we take it to the next level, we're going to highlight a couple of these here. So we're going to highlight the City ARIO. We're going to look at the gold ETF, how timely, since we're just talking about it. NASDAQ, S&P twice. We'll talk about why twice. And then you see we're going to look at the, what's DRC stand for again?
Daily Risk Control.
Daily Risk Control. Now, we're going to highlight those, but let's take our chart one step further. So what you're looking at now we added in, first we had the gross change, and then we're going to add in the strategy. So is it a par, a participation rate? Is it a cap index? Is it capped? What's the factor? So what was the cap, or what was the participation rate? And then what did that index actually return? What did it actually credit? What did your client actually see? And Kevin, will you talk a little bit about the caveats of how you end up on this list?
Sure. I mean, in some ways, it's pretty obvious. We're going for real world returns, right? And we're talking about 1-year index strategy. So in order to show a real world return for tongue twister there, real world return for a 1-year strategy, we need to have a strategy that's been in an indexed annuity for a whole year, so as to have a rate that we can apply to that 1 year's worth of performance. So for each of these strategies, so let's just go to the top, the AB All Market. We see the change in the index over the entire 1-year period ending April 30th, 2024. The factor 1 year ago that would have been applicable to funds allocated to that strategy was 190%. Putting it all together, if you put funds allocated to that strategy 1 year ago you would have received a credit of 0.34%. So basically, we need the strategy to have been around for a year to make this list.
Perfect.
And typically, we require it to continue to be around. So if there's a strategy that's been discontinued throughout the year, we've probably removed it from this
Why
list.
get excited about something you can't have?
Exactly.
So you'll also notice that you'll see, you might be wondering, hey, I don't see the crediting for some of these indices that are up here. Well, if the change was negative, as we all know in this indexed annuity world that zero is your hero. So if you see a gross negative on the index, well, we just are saving a little bit of time here. So let's take a look at those indices that we had spotlit. And it looks like we added the Paribas too. So Kevin, walk us through. What do we want to look at here?
Right. So just the distinction on the prior list, those are indices whose raw performance I thought was pretty good.
Yep.
This is where the applied interest credit tends to exceed. So I'm measuring two different things, highlighting two different things. So if you're highlighted on this page, it's because you had an indexed interest credit that was pretty significant. So that's how you made this list. So we saw a good performance. The BNP Paribas has been interesting for the last few months for a number of reasons. It's performed okay as a raw index. You see a 4.36% change for the trailing 12 months, which seems pretty meh if you think about it. But it's had some significant participation rates, including 245% as of April 30th, 2023. When you put those two things together, a meh change with a pretty significant participation rate, you get what ends up being a pretty substantial credit for your clients.
And that's where, and that's one of the things with the vol control, the designer indices, is that volatility isn't there. Fact check me, Kevin, because I'm going to get out.
Volatility is there. It's just predetermined.
So there's a better handle.
Yes.
On the volatility.
The realized volatility of the index. Yes.
And that allows the designer or whoever is the parent of the index, what should we call them?
I would say the hedge partner.
The hedge partner. It allows them the ability with their option budgets to be able to offer a 245%. So the raw number is not what, it's half the story.
Correct. The raw number is exactly half a story. If I'm being honest, I find participation rates at 245% to be a little, if uncomfortable is the right word, maybe counterintuitive. I mean, fundamentally understand how that can be. It's not that complicated. I just really don't like it. At the same time, you know what I do like? Nearly 11% interest index credits for your clients.
That is a nice thing. So walk us through. I see we got gold up there.
Right. Gold available as a cap strategy from a carrier. That cap 1 year ago was 11%. So it gives us an 11% credit, which is again, a very nice credit for your client. Going up to the top right, we see the Luma Sales Managed Futures. Again, very similar to the BNP Paribas conversation, 4.25% change over the trailing 12. Participation rate above 200%, you end up with a very nice credit for your client. It's interesting because when you have those very, very high participation rates, you almost create like it is a magnifying effect on the change in the index. So even a small change in the index ultimately can make a pretty big change in the credit your client's going to get. So it's kind of interesting when you think about, let's say, the difference between an index performance of 2% to negative 2%. That's not a huge difference. That's only 4%. But with the magnifying effect of that 200+ percent participation rate, the difference in credits could go from 0 to approaching 5 and 6%. So little changes can make a pretty big difference.
The thing that I like, there has been, I think, a backlash against vol control indices.
I think you can safely say that.
I don't even think I'm going out on a limb here.
Not controversial.
And I think part of the reason is I think maybe a misapplication and a misunderstanding. Maybe the putting all eggs in one basket, when really, you look at these different vol control indices, they're designed for different scenarios.
I think that's the nail on the head, but go ahead.
And I think this struck me maybe 3 months ago on one of our calls, where it finally dawned on me. I'd listened to a fund guy talk about risk and the way they diversify and the way they look at it, which was different than myself as a former advisor and somebody who talks indexed annuities. And it really dawned on me that, like, doggone it, if you have a vol control index, it's a lot like having your golf club bag full of different clubs. And if you're standing at the tee box and you've got a sand wedge in your hand and you tee off and the ball goes 30 yards, you can't be surprised because you had a sand wedge. That's kind of the same thing here. And that's the beauty of the modern indexed annuity, is that you have multiple options in there. But while I'm digressing, before I get too far in that rabbit hole, I love taking a look at the S&P 500 that we have up on this screen.
I do. And I just want to add to what you just said, and I think most people realize this, most of the indices that continue to be available were designed for lower interest rate environment.
Yep.
And we have new indices coming out. Those indices have made their way to the market. It took a little bit longer time than perhaps we would have liked. But those indices are going to perform better in a higher interest rate environment. And that's what we want. We just haven't quite gotten there yet. So as much as anything, it's the technology in quotes, kind of lagged behind where we needed it to be. And it's there now. And I think there's options available that work well in a higher interest rate environment. Again, going back to your golf club analogy, though, there will be a time when we need that sand wedge again. You will be happy some of these indices will be available if interest rates start to go down again, and they'll be very, very important to your clients and your practice. So please remember that. Maybe right now think about what you want to do in the current environment, but be prepared if we go back to a prior one.
I like it. All right, let's
S&P
just touch on the
500,
S&P 500. I always like to see the cap versus par, because I know that's a decision that you as advisors have to make.
Yes, and honestly, this is a lot of times it ends up being pretty close.
Yep.
In recent times, my own personal preference is for the cap, just because when you see caps that have been in double digits now for a little while, that's a very appealing story, and I feel like it's hard to go wrong with that. And as it turned out, for the trailing 12, it would have been better to be in the S&P cap, but that tends to go back and forth. The other one I always like to look at is the NASDAQ 100 versus the NASDAQ FC, because that's a pretty straight comparison between a vol control version of an index and a non-vol control version of index in totality. So with that par rate applied.
So when you're looking at that, just to direct your eyes, if you look to your top right corner, the NASDAQ 100, dark green, the NASDAQ FC is right underneath it.
That is correct. So effectively, NASDAQ FC is a fairly pure, there's a few bells and whistles, some actually very good bells and whistles, but bells and whistles apply to it. But it's a vol control version of the NASDAQ 100. So it's always great to see, okay, when you had the NASDAQ 100 pure version with a very limited par rate, or the vol control version with the NASDAQ FC and a much higher par rate, which one ended up being better? Trailing 12, NASDAQ 100 was better, but that has gone back and forth. That's not a consistent relationship. And a lot of time we've seen the NASDAQ FC strategies with par rate apply do better, but always something I keep an eye on. And then finally, you have that same relationship between the S&P 500 and right below it, the S&P 500 average DRC to percent PR, which ended up being pretty close to its brethren up above.
Nice. All right, so that's annual reset.
Annual reset, yes.
Let's talk about 2 years. So now we're talking, I'm going to do the math in my head. Actually, I said, there's 365. What is that? You're at math 730?
You don't need me, then.
Boom, 700.
You're killing it over there.
The last 24 months.
I think there was a leap day in there, though.
No, that's this year, isn't it?
We already had the leap day this year.
Okay, well, this is the challenge of being with an actuary here. Okay.
Or someone that knows calendars.
Your calendar skills. So we're looking at the last 24-month returns of those same building blocks. And what's crazy, as we work our way down, you see a big difference. Again, 24 months, you see a big difference down when we get into commodities.
Right. So there was actually, and if you look at the graph, you can see there was a pretty big bump in commodities about 2 years ago as inflation kind of spiked. Those have come back down. But what you're seeing is those commodities having come down from a pretty big spike. So that will start to level out as we go forward in the coming months, and see that being more or less level, I think. Oil can continue to be over all the place. But again, 2 years ago, oil saw a big spike as well. And so we're kind of coming down from that spike if you're looking at a 2-year point to point. Real estate's just been down, as we've covered. And everything else has done pretty well. Bonds continue to struggle again, and when you consider how they operate in the interest rate environment we're in. Gold looks pretty good. All the equities as well.
Gonna have to go. Okay, we put this up, a brief history, and this I think your conversation over the 2-year renewal time has been crucially important.
I just like to see where we've been and where we're going. We've talked about kind of how it's easy to forget what happened 2 years ago. I don't remember what I was doing 2 years ago. I can tell you that, I'm sure. So I like to remind myself, okay, how did we get here? We're in a 2-year environment where the S&P 500 is up a lot, but what's happened over that 2-year period and where did it come from? And really all of that gain over the 2-year period has happened in the last 6 months. As you can kind of see, we were more or less flat, and then suddenly there was a there was a big spike at the end of 2023, and that's basically more or less continued. So just it's important to remember that. How did we get there? What happened? What's that going to mean going forward? And we're going to cover what's going to happen going forward in an upcoming slide. But I think that's a really important thing to note.
Yeah, I think so too. I think there's going to be, as we watch new products roll out, I just feel like there's going to be less and less funds allocated to 2 years because of that rough stretch we had.
Talking to our carrier friends, everything that I see tells me that's the case. I do hope people, remember there'll be a time for the 2-year strategy again. It might not be right now, but there will be a time.
Yeah, it's just, I think it's human nature to swing from one direction to the other pretty harshly. Okay, so 2-year results. So now we're going to look at, again, there's the indices. We're going to look at the gross change. So that's the gross number. We're going to add the strategy, the factor, the credit, and we're going to focus on the right side. And Kevin, of course, I ask this every time just for clarity. When we look at those gross numbers, is that an annualized number or is that over the 2-year period?
Those are not annualized. Those are total 2-year point-to-points.
All right, so let's take a look. Let's fill out the chart. And when we fill it out, so again, we add the strategy, par spread. If there's a cap, actually there's not a cap up there, and then the factors. And so you'll notice that there are indices that had negative gross returns. So we just did not do the math all the way through. Those that did have positive, they're just zero's your hero again. But those that had positive numbers, positive returns, we went ahead and added the strategy factor and the credit. And let's talk about those handful that we're going to talk about, Kevin.
Right. So 2 years continues to be a kind of a challenge in the FIA space. A few things to remember. 2 years ago, we didn't quite have the rates that we have now.
Mm-hmm.
The interest rates had started to tick up, but we weren't all the way there yet, and that's evidenced by an S&P 500 par rate that's at 45%. I think you can get close to 60 now. But we saw our 1-year S&P 500 par rates that were available 1 year ago, and those were above 50. So we were seeing rates start to climb, but they weren't there yet. So that's part of what's muting some of these returns. And then part of it is just some challenge on the 2-year front. We've talked about some of the reasons for that, some of the kind of allocations that happened that kind of drove those results down. But certainly it's been a challenge, and we don't see a ton of great performers. Even the S&P 500, which is up a lot in terms of raw return, the actual credits over a 2-year period are okay, probably not great. At the same time, we've also talked about what constitutes a good return in an FIA, and I continue to have that debate with myself and others. But one thing I've really started looking at is what were the fixed rates available a year ago or 2 years ago, and the fixed rates available 2 years ago were in the neighborhood of 2.5% to 3%. So if you're outperforming 2.5% to 3%, then you probably did better than. Or the FIA probably fulfilled its promise.
You look at this and it's so easy. It is very easy to forget that what we're looking at here is we are looking that the indexed annuity is a safe money product. And when I was just thinking while you were talking, Kevin, when I'm looking at that S&P, if 2 years ago someone said, hey, I'll tell you what, you can go S&P 500, come what may, or for your safe money. Again, no product is perfect for every ounce of somebody's asset base, right? But if somebody said for your safe money, how about we do this? How about we go 45% of whatever the S&P does? Anything below zero, it's just do over. That's a hell of a deal for your safe money.
2 years ago, it was definitely a deal.
Yeah,
there's no question. Again, it's that recency bias. We're used to like getting really high par rates, really high caps. It wasn't that long ago that those were still pretty low.
Spot on. So we're back to this slide.
Yeah, so I just want to look forward a month, kind of see where we'll be when we do our 2-year ending at the end of May. So at the end of May, 2 years ago, we were actually right around the same number we were for April, which is about 4,100. But if the S&P continues and is level where it's at now, that means it will continue to be pretty high, and pretty soon we'll start to drift into those starting points with higher interest rates, and I think you'll start to get some of the upside of higher pars.
Nice. Okay, so we're going to dive in. We're going to dive a little deeper.
We are.
I'm a little worried because off air you said there's a quiz, and I hadn't looked at your slides.
Oh, okay, the quiz. This isn't what the quiz is. So as I understand it, I was perhaps dropped from last month's episode, Dennis. Is that possibly correct?
There was a recording error, so I had to have somebody pinch hit, and we walked through here. But
got it. So I don't know if you covered the same things I would have covered. I'm sure you did a wonderful job, but just in case not everything I wanted to say was covered, we're going to go ahead and cover it now.
Okay,
if that's okay with you.
So for those of you that weren't, if you weren't on the last call, Kevin and I actually pre-recorded it, which was weird because we prefer to be live. There was a recording error, my fault. Well, actually, there was a power surge.
I don't think that I put that on your shoulders.
But so what we had to do is I had to find someone to pinch hit for Kevin, and I played the role of Kevin, which meant the numbers and such was on me. But I tried to go off what I remembered. But we had a request to talk about the Barclay Shiller Global because it's been a performer and people were curious. So this is where we peel back the onion. So now we are going to correctly make sure that we dice that onion. So hit it.
You did a wonderful job. I just want I want to get my at bat. So that's my plate appearance. So that's what we're going to do. Barclay Shiller's Global. I'm sorry, you don't think about baseball. I'll explain that later.
That was a very nice way of saying that you wanted to make sure I didn't mess it up. Go ahead.
Barclay Shiller Global Index is performing very well, both kind of on a raw basis and on a credit applied or a participation rate applied basis. So why has it been doing well? I think that's a reasonable question to ask. And so we're gonna go ahead and look at it. We see the Shiller, how it's comprised. It's got this. It uses the Shiller CAPE ratio to kind of determine where there are values in U.S., Eurozone, and Japanese stocks, and it allocates 60% to those particular, potentially 60% to those particular areas. It also has the potential to allocate to commodities and bonds. However, it does this on a very selective basis when there is positive momentum defined by a formula I'm not going to go into. But there's a way to do that. So it can be in commodities. It might not be. It can be in bonds. It might not be. I think that's, especially with the bond component, that's proven to be a very, very valuable because as we've noted and kind of when we talk about the asset class and how they've been performing, we haven't seen a lot of positive bond performance. As a matter of fact, we've seen some negative bond performance. The ability to get out of bonds, in my opinion, is pretty crucial. And we've kind of seen that here. So I think on the next slide, we show maybe the possible allocations. Effectively, it's going for value in stocks. So using that CAPE ratio that most of you are probably familiar with. I'm not going to pretend to be a commodities expert, but it's also looking for value in commodities using this methodology. Carry costs, again, not my area of expertise. So I'm just going to take for granted that whoever put this together knows what they're talking about.
I do have to point out two things that I find fascinating on the commodities. One,
yes,
my girls are 29 and 33. I don't think they would have a clue if I said regular gasoline, because if you look down the right side, you see unleaded gasoline. Fascinating, but I guess outside of the States, that would be a thing.
Yeah.
And then the other thing is, since we're in Kansas City, I see Kansas wheat.
I know. I was pretty pleased about that myself.
Yeah.
I think, are we the only region that's highlighted?
There is nothing from Nebraska or Omaha.
That's
Oklahoma, right. And no fat hogs, just the lean hogs.
That's right. Take that Missouri, take that Nebraska, take that Iowa.
There we go.
We're talking Kansas wheat here. But yeah, so I'm going to take for granted that accomplishes what it's supposed to accomplish. And then finally, it has the three possible durations of U.S. Treasuries, 5, 10, and 30, and then some cash if it needs to. So let's go ahead, and this slide might take a little while to load.
While it's loading,
intensive.
While it's loading, it is graphic intensive, and it's a great slide. Is Barclays available on an annual point-to-point?
This index is not available on an annual point-to-point. Only a 2-year point-to-point right now.
Okay, she's loading. There it is. That's
there
a beautiful slide. Lots of color.
Yeah, there's lots of color. It takes a while to render, but you can kind of see where the allocations have been over time. Green commodities, the orange hues are the various durations of bond exposure, and then the blues are the various equity exposures.
Now, Kevin, I can't help but notice that I see several instances, several time frames where I don't see the color orange or its kin.
I am glad to know that you are not colorblind, Dennis. That's exactly correct. There are times, as we've talked about, this index has the ability to get out of treasury or bond exposure in total, and the ability to get out of commodity exposure. So let's go to the next slide, which concentrates on just the last 2 years.
Let's see that little.
All right, that one's a little bit faster. Again, the color you won't be seeing on this is orange. So there was no bond exposure under the trailing 2-year period.
Now, this has got to be one of the few vol control where the bond can go to zero.
I think it's becoming more and more common. 2 years ago, I don't know that it was. Now, I didn't go back and look at everything, but my understanding is that it probably wasn't as common to be able to be completely out of bonds on like you said, a 0% basis like this is. But it was definitely the case that this was there were no bonds, no bond exposure to this index over the last 2 years. So let's go ahead and look at then the kind of attribution for what was there, which is the commodities, which we're going to show here, and then in a minute we'll do the equities. So this is the commodity allocation for the in blue over the last 2 years. So it's been hovering around 10%. It went to 0 for a little bit in 23 and at the beginning of this year. But it's been hovering between, that 10 and 20% exposure rate. And then you see the actual commodity performance going up and down. So I did a weighted average performance over this period. And effectively, what this very, very cool graph gets you is virtually nothing. The commodities barely impacted the price of this. My, again, very rough calculations. What is it? The total applied return to the index over the entire 2 years was about negative 40 basis points. So effectively, bonds were out of the picture. Commodities weren't, but they didn't really overall have a huge impact on the performance of the index. They were effectively neutral for all this slide. Here's what really mattered. Again, probably not a huge surprise to people that have been watching. It was really the equities that drove the show. So for the first, let's say 6 to 8 months, the equity performance of this index, again, spread between European equities, Japanese equities, and U.S. equities, was more or less neutral. And I don't know why the dates are showing up in Excel number code here. But
yeah, I was just thinking about that.
I'm not sure why that happened, so you just have to forgive me. This is the recent 2-year period. And so more or less 2/3 of the way through, it'd been up and down, but effectively neutral. From that point forward, so let's just call it the last 15 to 18 months, the equity constituents of this index are up approximately 30%. And as you can see, over that time period, again, the exposure to that equity performance has gone up and down, but it's been very high recently and, averaging around, let's say 40%. Does that seem fair?
Yeah.
So putting those things together, and again, this isn't complex math. You had a roughly, average 40%, and maybe it did some good guessing where it got out during some downtimes and got back in during some uptimes. But effectively, you put it all together, up 30%, roughly 40% exposure, you got about a 12% return, which if you go back to our 2-year slide, that's exactly what you would have seen, about a 12% index performance over the trailing 12 years, which tells me, and as we've discussed when we consider the commodity slide, it was really equities driving the show. You apply a pretty generous participation rate to that, and you end up with a good credit over a 2-year period. And that's how it was built.
Currently, this is only offered by one.
Correct. This is a proprietary index. You're only going to find this at one company.
And then any indications? Have you heard any rumblings of just maintaining a 2-year, or do you think there'll be a 1-year?
I would not anticipate that changing.
Okay. Fantastic. I mean, that is such a deep dive. It's an interesting thing to get into the weeds.
In some ways, it's almost anticlimactic. It's the equities, dummy. It was the equities that drove the show. But still, it's good to know. It's good to know there was nothing else that was really pushing there. It was the equity exposure, the right equity exposure, and really the right timing of the equity exposure that drove.
All right, so I'm concerned because you said you had like a quiz, and I hate being surprised on the air.
I think you'll do very well, Dennis.
Okay, so what are we looking at here?
All right, so I don't know how many of our audience members are familiar with the Retirement Income Journal. It's authored by a financial reporter, Kerry Pector, who is exceptional. He does a lot of good work. If you haven't ever checked out the Retirement Income Journal, please do so. But he was very kind enough to talk to yours truly about index construction, specifically excess return and what that means.
You did a nice job.
That's a pretty great topic. Kerry was great to talk to. I really wish that we could have, we spoke for about an hour, and there was a lot of stuff that ended up on the cutting room floor that I thought was lots of fun to talk about. So I'm kind of bummed that that was the case. But regardless, Carrie did a really good job and does a really thorough job of investigating topics as they relate to insurance. And a lot of times that means FIAs. Anyway, it's a good article. Check it out. But one thing I've been meaning to tackle, and this prompted me to do it, PR, ER, TR, what are they? What does it mean? Why is it important to you? And how is it really impacting fixed index annuities? So here we go.
This is very useful because there are a lot of terms and a lot of things that we say and a lot of words that we use that we kind of understand, but we don't in truly we don't get it. Like you can say it, I could tell you the definition back, but like deep down I might not get it. But okay, PR. I'm going to go with price return.
Very good, Dennis. You sure you didn't peek?
I do have the slides over here. So,
okay,
so PR price return.
You're on the honor system.
Okay,
all right, there we go.
I'm covering with one hand.
There we go. Next one.
Okay. Next up, we've got TR, which should stand for total return.
Good. Excellent.
Okay.
I should have made this way harder. You're gonna get an A without even really trying.
Well,
all right,
I do work here. ER. I'm going to go with excess.
That is correct, Dennis. Excess return.
Okay.
So these are ways to describe index construction, and we're going to talk about what each of these mean. But you'll see these attached to indices sometimes, and you might wonder what they mean. Perhaps you already know. Let's eliminate any confusion, avoid any doubt, and let's define them.
This really is just exactly what I was saying. So I know I glance out of the corner of my eye, and I know that there's writing underneath price return.
Yes.
And so, but getting into the weeds here, this is super important stuff. Okay, so price return, it says index movements based on the change in the price of the constituents. Tell me what that means. Dumb that down for me.
Basically, this is just what most people think of when they think about an index. So the S&P 500, we all know it's a market cap weighted index. So when the various constituents of the S&P 500 move in price, depending on how big their market capitalization is, that moves the value of the S&P 500. So that's all it is. When you think of an index, you probably think of a price return index. All of the benchmark indices, all of the equity benchmark indices, I should say, are typically price return index.
You're just comparing point A, point B.
Point A, point B, nothing else going on.
Okay. And this one, I know what we're going to see here. Yeah. I don't know why I'm putting my hand up.
I don't know either. Yeah.
Just for fun. So, this is where, and this is one. So I have two brothers that are big advisors, and we get into arguments and we talk about exactly this. We talk price return. They're like, what about the dividends? And it's a total return index plus the dividends.
Yes. I mean, that says it is what it is. It's index, but assuming that you reinvested the dividends into, so some constituent of the S&P 500 has a dividend, you assume you reinvest that into the index, and that increases the price or increases the value of the index. So it's interesting. Sometimes I get questions about TR, people perhaps wishing that more indices inside FIAs were TR. There are a handful. They're not very common. I tend to disagree, and there's a few reasons. I'm actually curious what you think, but here's my reasons. Number one, dividends inside.
Wait, do you want the wrong reasons first? Because I can supply those.
Well, I have my reasons. I'm curious of your reasons, so they can both be right, Dennis. This is not a zero-sum game.
I would just think I'll go first because you're going to say the correct thing.
Okay, fine. Go ahead.
I call this Matern's law, which is just an intuitive thing of the more you get, the more it costs, which then would probably get you a lower participation rate, or it costs more, so you're going to get less.
I think that's a very marketing reason, and it's different from my reasons, but yet completely valid. So,
well, you're feeling nice today. I like that.
So here's my reason. Number one, dividends in the context of insurance products means something different than what it means to a.
Oh, good point.
Yeah, so a lot of times, if these aren't as common, they certainly exist. Our friends at New York Life like to build their reputation on this. Insurance products can have dividends themselves, which are effectively profits from a mutual company being redistributed to policyholders, and that means something. And so it's different than the dividend that you and I might talk about as a stock company dividend. I think
used to work
creates a lot of confusion.
I used to work for a mutual company. We were proud of our dividends, and that never crossed my mind in this context. Thank you.
Maybe my reason's not as good as yours. Another reason. So let's say you're an advisor and you're telling someone that you are going to put them into an S&P 500. This is hypothetical. S&P 500 total return index with a 50% participation rate. Do you think it's possible that your client could be confused and think that they're going to get dividends. And then the index, the total return index is down, and they're wondering like, well, that's fine. I still get my dividends, right? Wrong. You are not getting your dividends. The index just considered those dividends in its calculation, but it was still less than zero. So you got nothing.
That's a good point. Another good point.
I think that create a lot of confusion. And then my final reason is actually basically what you said earlier. It's, it's a pricing issue. It's also a simplicity issue. Like, do you really want to?
That level of complexity. You're just adding levels of complexity.
Exactly. Are you getting the value for your are you getting the appreciated for the value to bring in the total return index? I'd say the answer is no.
I have to say you gave me two really good points to ponder that I hadn't even thought about. Well done, sir.
Every once in a while.
Okay. Excess return.
Excess return. And this is where we start to get into something that's really important. Index movements are based on the change in the price of constituents, like we just talked about. So far we're in price return land, and here's where it gets different. In excess of a hurdle rate. So that means excess. What's it in excess of? The return is in excess of a hurdle rate. Also, an excess return may or may not actually have dividends included. So there's a handful of S&P 500 vol control indices that are excess return, but also include dividends, but some don't. And you have to dig to figure out which ones do and which ones do not. So the question is, what is this hurdle rate? And perhaps more important, why? Why is this hurdle rate?
These are, if folks, you could see me, I did the same thing you all probably did, unless you knew the answer. I folded my arms and gave Kevin the look of who sets the hurdle rate. And that's exactly what I was going to ask.
So here's the thing. Every index could use a different hurdle rate. Mm-hmm. So let's say, the hurdle rate it's typically a U.S. risk-free rate. So you think of a few different things that could be. It could be like the U.S. federal funds rate. It could be the SOFR, which I think is the secure overnight funding rate, effectively what took the place of LIBOR. It could be that. But effectively, it's a very short-term risk-free rate, and that's the hurdle rate. The good news is you don't change what that rate is. That rate may change itself, but what that reference hurdle rate is defined in an index. So you can go and you could look up index methodology for every index and know what that hurdle rate is. But let's talk about how that hurdle rate's applied. So just in very basic terms, the hurdle rate is quoted on an annual basis, but it's applied on a daily basis. So let's say over the course of, just for super, super easy math, let's say that the hurdle rate is currently at a 5% on a given day. That's an annualized rate. Let's just say there's 250 business days in a year. So that means the hurdle rate on any given day may be effectively 2-ish basis points, let's say. So let's say a price return version of an index is up. Let's say it had a big day and the price return version is up 1%. Let's say an otherwise identical index, but that's excess return would be up 1% minus those 2 basis points. And so over the course of an entire year, every day you're kind of effectively subtracting those 2 basis points. So at the end of a year period, comparing a price return index to an excess return index, if that hurdle rate stayed at 5% over that whole period of time, which probably wouldn't happen, but let's say it does, the price return index should be the change in index should be 5% greater than the excess return index. And that should be the difference. And we're actually we're gonna go to the tape, Dennis.
Let's take a look.
We're gonna show how this works in real terms. So here is an index that is used in an indexed annuity in its price return version, actually. The S&P 500 average daily risk control 10%. This is over the period, effectively the calendar year 2016. So beginning 12/31 of 2015, last day of 2015, all the way to the end of 2016. So effectively calendar year 2016 return, we see the PR and the ER versions of this index, because both are out there. Only the PR version is available in an FIA, but both versions are published. So you can go and you get this information directly from our friends at Standard & Poor's. And I don't know if you can remember 8 years ago, Dennis, but 8 years ago, risk-free rates were quite low. to the tune of, I believe, less than 1%
Huh.
for most of the year. And so because those were very low, that hurdle rate we just talked about for this particular index, which happens to be that SOFR plus a couple of basis points, it was also very low. And so the PR and the ER performed very similarly. So I think that's a demonstration of, how they can perform. Let's look at 2023.
Now, some separation.
Some separation. So as you can see over the course of the year, that excess return mechanism kind of drug on the performance of the ER version of the index, and it ended up being, I see the PR looks to be up just lower than 16 maybe, and the ER is just above 10. So we're in the neighborhood of 5%, which over 2023, the risk-free rates, the risk-free reference rates, we're at about a 5% level.
That's a pretty big gap.
So there you have it. Now, the question, of course, is, and you alluded to this earlier, but we'll just touch on it, then why would you ever want an ER index? Well, for one thing, an ER index is going to have a higher participation rate. So that is a thing. So it's not like we used to have that conversation, right, about in the very early days of FIAs when there was a 10% cap. Well, what happened to the rest of the money, the rest of the increase? Why didn't I get it? The insurance company must have kept it, those greedy jerks. No, that's just option pricing, and this is just option pricing as well. But it does beg the question. So spoiler alert, just about every index available right now in FIAs is an ER index in some form. There are a few TRs. There's obviously the PRs, like the benchmark indices are all PRs. But most of the vol control indices are ER indices. And why do they do that? And I think that's super important. And so I think we should discuss it. Let's go to the next slide. Oh, oof, here we go.
I'm out.
Boy, yeah. So another quiz. What is this, Dennis?
These are probably the calculations to determine the returns on the ER and the PR.
Close. These are option pricing calculations. This is specifically the Black-Scholes formula for a call option.
I don't even know what that one symbol is. I mean, I'm not bad at math, but this I fail right here.
Have you forgotten your calculus, Dennis?
I have forgotten my calculus.
Well, regardless, so this is the Black-Scholes formula. This isn't precisely how index prices, call options specifically, are calculated, but it's a generalized formula that's at least going to give you an idea of the price of an index. So I don't want to bore people with calculus, so we're just cut to the chase. Go to the next slide. I have circled 4 pretty important symbols that occur in this. R occurs twice and sigma occurs twice. R is rate.
Gotcha.
Okay. And the sigma is the standard deviation or volatility. And so if you introduce a ER volatility controlled index, what happens? Effectively, that R is being reduced by, you have a risk-free rate, and it's also being reduced by that same risk-free rate. You're effectively doing R minus R because you're subtracting out that risk-free rate that we talked about. That goes to 0 in very broad terms. So if you're a quant listening to me, I understand this is exactly correct, but it's the effectively that term goes to 0 when you have an excess return index. And then finally, you have that sigma, the volatility. As we all know, in a volatility control index, the volatility is fixed. So if you've reduced R to 0, and you fixed your volatility, what you've done is you've created a very, very stable option price. And so the net impact to rates as a policyholder, if you have an ER index, is those rates are going to be very, very stable. The cost of hedging those options is going to be very, very stable, and you can expect to have very, very stable renewal rates in your policy. The other impact is that by controlling volatility and reducing R, you also reduce your option cost in comparison to an otherwise similar price return index. And then what you have is a lower hedging cost, which translates into a higher participation rate. So the net effect of an ER index is really 2 things. Number 1, you have highly stable option costs, and therefore you should have highly stable renewal participation rates. Number 2, those rates are going to be higher than an otherwise comparable price return index. So you've got something that's going to give you higher par rates and something that's going to be very, very stable from a participation rate standpoint. So those are the upsides. The downsides are, of course, that you're going to get muted performance in an ER index versus an otherwise similar PR index. And that is probably some of what's creating some problems right now on some of the vol control indices. That ER mechanism is pulling those returns below zero, and you aren't getting that amplified effect of the 250% types of participation rates. You're effectively, if you want to put it into index and FIA strategy terms, Dennis, before your eyes completely glaze over, volatility control kind of creates an embedded participation rate, right? Your exposure can go up and down based on volatility. The excess return mechanism kind of creates an embedded spread that can go up and down in the same way. So you have basically an embedded spread and an embedded participation rate, not inside the index strategy, but inside the index itself. And that helps create the effects that we're talking about right now.
I will say very interesting. And we hit weed down. we went into the weeds, but that's fascinating. I've never seen
I think it's important. I think I kind of just threw in the formulas because I thought it was funny, but in reality, that's what happens. Your ER VC indices are indices that have an embedded spread and an embedded participation rate inside the movement of the index itself. So you can afford to have a very stable participation rate at the index strategy level.
I think understanding that I do think, but kidding aside, I think that is very important to understand those differences, because we use these terms a lot of times, not flippantly, but pretty close to flippant. We're just casually throwing them out there, and they really have some significant impact.
Before we get to this, I do want to finish this, and I'm curious. Question for our audience: is the juice worth the squeeze? So now we've talked about all these indices that are available with highly stable renewal rates, but perhaps muted performance. Would you rather have that muted performance, or would you rather have renewal rates that can go up and down, knowing that you have that muted performance? It's the give and take of FIAs and indices inside FIAs right now. I'm not sure. I don't know what the right answer is for you or your clients, or what you would actually want, knowing these facts. But I am insanely curious.
I think that I think that most advisors would probably say. I would think that you would almost lean towards. I think you'd lean towards the stability of renewal rates, because there's nothing worse than that renewal rate if it comes back and it's just not good. That's a tough conversation to have.
Is that worse right now? And again, this is only one time period. Than having S&P 500 up 20% and having an index inside your FIA getting a zero for that period. Is that not? I don't know.
That's a tough one too.
I've never done, Dennis. I've never sold an FIA, so I don't know. But
eyeball to eyeball with clients, it's a whole different ballgame.
I can only imagine, and I'm grateful for our advisors that do that work, because I could not.
We'll have to talk about. We'll have to get some poll questions for next time.
I agree.
Let's talk interest rates.
Always fun to see what interest rates are doing. We continue to be inverted in interest rates. What's interesting to me is kind of the behavior over the last, let's say 5 months. Basically all of 2024 on interest rate movement in the 10-year and 2-year durations. At the beginning of the year, you may or may not remember, the Fed kind of said or implied, or the market interpreted from its statements, that they're going to be 6 rate cuts over the course of the year. But 2 things have happened since then, Dennis. We've seen continued inflation, and we haven't seen any rate cuts. And so we've seen those longer duration bond yields start to creep back up as the market realizes, hey, wait a minute, we might actually be higher for longer. And so we're creeping back up into the area we were towards the middle end of 2023.
It'll be interesting to see, would be looking back and seeing, not proposing any work for you.
Of course not.
It'd be interesting to see what U.S. Treasury yields for the 10, 2, and 3 were back, say 1978 to like 82.
Higher.
Thank you. But like what the curve looked like. We had a high inflation. We had high commodities. We had political election at that time. We had just the malaise speech and all that. That would be interesting to see. We
can take it back. I think we can take it back further. I think that data is pretty readily available. So we'll find out for next time.
Now, speaking of that, we are at the end of our time. I'd like to thank you for joining us. We'll take a pause for, if you do have some questions, you can feel free to type them in the chat or the Q&A, and I'll ask them for you. The Q&A is private. Only I see that. Chat everyone sees. And we'll get the current issue out to you as soon as I walk back to my desk. I'm going to shoot it out
Perfect.
to folks. But let's pause for just a second, Kevin. Any thoughts? Anything you're looking at as we go from May to June?
Really just interest rate focused. I think inflation numbers are due out. Wholesale inflation was out either yesterday or today, and it was high.
Mm-hmm.
And so I think that's going to continue to support that higher for longer on interest rates, which is, I mean, frankly, good for our business. We've seen FIA sales continue to set records, and that's really interest rate driven. We've always wondered what a high interest rate environment would look like if it coincided with a bunch of people retiring, and that's what we're seeing right now. And it's a really cool thing to see.
You know what? That's a good spot to end there. Didn't any questions pop in? That is A-okay. And so I'm going to do this. I'm going to say on behalf of Kevin Cloud, on behalf of myself, on behalf of CreativeOne, I'd like to thank you for taking time out of your day to join us. If you have any questions, if you have any indice that you'd like us to lift the hood on and break that thing down, shoot it over. We'd love to do that. If not, we will see you same time, same place, 1 month from today, second Tuesday of the month, 3 p.m. Central. Have a great one. We'll see you later.